Listen up, because the real story of a company isn't just in the spreadsheets, it is in the opening pages. Today, we are breaking down the management narrative, dissecting the CEO's letter to shareholders to see what management is really telling us and what they might be leaving out. Let's get to work. You want to know where a company is headed? Read the CEO's letter. This is the management narrative. It is the curated storyline that leadership wants you to digest. But we do not just read it, we dissect it. We look at the what and the why. Is the CEO stepping up to the plate and owning the misses, or just taking a victory lap? When we look at Jensen's fiscal 2025 letter, it is a massive victory lap. And frankly, with revenue hitting $130.5 billion, a 114% jump, they have the numbers to back up the cheering. But here is the critical part: you will not find apologies here. There is no mention of the supply chain bottlenecks or the complexities of transitioning architectures that we see buried deep in the risk factors. The tone is heavily focused on what the CEO calls a structural shift. As an analyst, you must note this: the narrative is purely forward-looking and celebratory. We establish the baseline here so we can measure how the strategy evolves in the next phase. Look at this flow. We start by identifying the core narrative in the CEO letter. Then, we analyze the tone. Is it accountable or celebratory? Next, we lock that tone against the hard metrics, like the $130.5 billion in revenue. Finally, we isolate the omissions, the things they aren't saying, like underlying supply constraints. Now we dig into the meat of the letter, the strategic pivot. This is where you separate the noise from the signal. You are looking for the exact language the CEO uses to redefine the business. Why? Because language dictates capital allocation. Jensen writes, fiscal 2025 was not a transition, it was a break from the past. That is a massive statement. He is explicitly telling us the old model is dead. We went from a chip company to a full-stack platform to the AI infrastructure company. He highlights that inference and real-time reasoning are now the dominant workloads, overtaking training. This tells us exactly where the research and development dollars are going. When a CEO declares a break from the past, you have to update your models. They are no longer selling just chips, they are selling AI factories. You must capture these direct quotes because they are the compass for the company's multi-year trajectory. This diagram maps the strategic evolution outlined in the letter. We move step by step from phase 1, a traditional chip company, through the full-stack platform phase, landing right here at phase 3, the AI infrastructure company. This leads directly to the future state of deploying AI factories and agentic AI. Finally, we connect the grand vision back to the balance sheet. Vision is great, but execution costs money. In the letter, the CEO addresses the fact that operating expenses shot up 45% to $16.4 billion. Now, does he apologize for the massive spend? Absolutely not. He frames it as investing at pace with discipline, efficiency, and purpose. This is textbook narrative control. You take a massive cost increase and position it as the essential fuel for the new industrial revolution. But we also have to check for financial accountability. Are they just burning cash? The letter strategically includes the fact that they returned $34.5 billion to shareholders through buybacks and dividends. That is how the management narrative works. You acknowledge the aggressive spending required to build the AI infrastructure, but you immediately cushion it with the massive capital returns to keep investors confident. That is the complete picture. Here is the visual breakdown of the capital allocation narrative. You see the $16.4 billion in operating expenses, representing the aggressive investment in the future. But look at the larger slice, $34.5 billion returned to shareholders. The narrative successfully balances aggressive growth with heavy capital return. Welcome, learners. Today, we are breaking down the financial architecture and revenue segments of a true data center scale infrastructure leader. Let us get started. Listen up, learners. We are diving straight into the financial engine of this infrastructure powerhouse. What is the business model? It is a fabless manufacturing strategy paired with a unified platform approach. We are looking at an operation that does not just make chips, it builds data center scale systems, bringing together hardware, interconnects, software, and services. Basically, they operate through two primary reporting segments: compute and networking, and graphics. Why does this matter? Because the programmable nature of their architecture allows them to support multiple end markets using the exact same underlying technology. That is operational leverage. How does this translate to revenue? In fiscal year 2026, total revenue reached an incredible $215.9 billion. The compute and networking segment generated $193.4 billion, up 67% year-over-year, driven entirely by accelerated computing and artificial intelligence. The graphics segment brought in $22.4 billion. This represents a massive structural shift in the computing economy, moving from traditional coding to AI model training and real-time inference. Look at this chart. It is clear and undeniable. Compute and networking represents the lion's share of the $215.9 billion total, making up over $193 billion. Graphics is still a solid business at over $22 billion, but the absolute dominance of compute and networking shows exactly where the core of the business operates today. Now let us dig deeper into the specific market platforms. What are the end markets driving this machine? We track four main areas: data center, gaming, professional visualization, and automotive. The absolute heavyweight here is data center, which posted a staggering $193.7 billion in fiscal 2026. This breaks down further into compute at $162.3 billion and networking at $31.3 billion. How did they achieve this? By introducing critical new business lines and architectures. During the fiscal year, the company ramped up massive-scale production of its new Blackwell AI supercomputers. Furthermore, networking grew rapidly due to the introduction and ramp of the NVLink compute fabric for GB200 and GB300 systems, alongside Ethernet for AI solutions. Gaming brought in $16 billion, driven by the new Blackwell GeForce RT X50 series, while automotive grew 39% to $2.3 billion due to autonomous driving platforms. This platform strategy creates unique value across completely different industries using a unified architecture. Breaking down the market platforms visually, the slice for data center completely dominates the pie at $193.7 billion. You can see gaming at $16 billion, professional visualization at $3.1 billion, and automotive at $2.3 billion. This clearly illustrates that data center AI infrastructure is the primary engine of growth. Finally, let us examine the geographic breakdown. Where is this demand coming from? We must look at revenue based on customer headquarters. The United States is the undisputed leader, generating $149.6 billion in fiscal 2026. Taiwan follows with $42.3 billion, and China accounts for $19.6 billion. How do regulations play into this? It is critical to understand the compliance and geopolitical landscape. The company faces shifting export control restrictions from the United States government, which mandate licensing requirements for certain products exceeding performance thresholds destined for China and other specified countries. Despite these export controls, the company navigated the constraints by expanding its data center product portfolio with compliant solutions. Why is this geographic distribution important? Because securing data center capacity and energy is a global challenge. As the company expands into new regions and sovereign AI clusters, understanding where capital and infrastructure are being deployed helps us analyze the durability of this revenue model. This geographic pie chart tells a striking story. The United States slice is massive at nearly $150 billion. Taiwan represents the second largest portion, driven largely by demand from global end customers, while China and other regions make up the remainder. This highlights heavy geographic concentration and illustrates where the capital for AI infrastructure is currently flowing. Welcome, everyone. Let us get right to work analyzing the structural advantages and competitive battlefield of this technology platform. Listen closely, because understanding the competitive landscape of accelerated computing is absolutely foundational to analyzing this business. We are looking at a market defined by rapid technological shifts and intense, well-funded competition. Who is challenging the company? It is not just the traditional semiconductor players offering alternative GPUs, CPUs, DPUs, or embedded systems. Management clearly identifies a multi-front battlefield. You have companies providing semiconductor-based high-performance interconnects. But here is the real curveball you must monitor: the customers themselves. Major cloud service providers have the in-house expertise and capital to develop their own internal custom silicon and cloud-based AI services. Some competitors operate their own fabrication facilities, meaning they control their manufacturing destiny in ways a fabless company must navigate carefully. This is a complex arena where competitors might offer lower prices or attempt to leverage larger existing customer bases. To survive and lead here, a company needs much more than just a fast component. They need a structural advantage. This flowchart maps out the three primary competitive threats facing the company. At the top, the landscape divides into traditional semiconductor rivals, interconnect providers, and in-house customer silicon. Notice how each node specifies the exact operational threat, flowing down to alternative components and custom cloud chips. Now, why does the company maintain its position despite this fierce competition? Let us transition to the concept of the moat. The basics here are all about the full-stack computing infrastructure. We are no longer talking about selling a standalone chip. The strategic pivot is architecting and designing end-to-end AI factories. How does this work in practice? The company co-designs the GPU, the CPU, the NVLink switch, the DPU, and the scale-out networking. This deep hardware integration creates immense performance efficiencies that are incredibly difficult for a competitor offering just one piece of the puzzle to replicate. When management outlines their advantage, they emphasize this data center scale capability. It forms a massive barrier to entry because a rival cannot just build a fast chip. They must build the entire integrated system, solve the complex interconnect bottlenecks, and ensure it operates efficiently at scale. This full-stack approach fundamentally alters the competitive dynamics, shifting the battle from basic component specifications to total system throughput. Here we illustrate the hardware moat. The full-stack AI factory at the top relies on three foundational pillars: processing, interconnects, and networking. Observe how all three converge into integrated system performance, leading directly to a high barrier to entry for competitors. Let us dive deep into the ultimate unfair advantage, the software ecosystem, and the network effect. This is the glue that secures the moat. What is the foundation? It is the CUDA programming model. Over 7.5 million developers worldwide use CUDA and related software tools. Why is this metric critical? Because specialized software creates formidable switching costs. When an entire global ecosystem of developers writes and optimizes code for one specific architecture, transitioning to a competitor's hardware requires massive software rewriting, testing, and validation. How is the company expanding this moat today? By deploying enterprise-grade software like NVIDIA AI Enterprise, NM Microservices, and NeMo. These suites simplify the deployment of complex generative AI for corporate end users, effectively anchoring them to the ecosystem. The more developers use the platform, the more applications are built, which in turn mandates more hardware adoption. It is a classic, powerful network effect. This combination of deep software integration and a massive installed base of developers constitutes a defensive position that is exceedingly difficult to breach. This cycle diagram shows the network effect in action. The CUDA software platform attracts a massive base of developers, which builds a robust application ecosystem, driving hardware adoption, which feeds right back into strengthening CUDA. The enterprise suites act as an accelerator to this entire cycle. Welcome to the session. Grab your notepads. Today, we are tearing into the fine print. We are looking at the exact risks management is watching right now. Let's get started. Listen to me, you have to read the risk factors. The first massive risk is export controls. We are not talking about a theoretical scenario here. This is an actual, realized event. The government dictates performance thresholds, and if regulations change, access to major global markets is cut off instantly. Remember, 31% of revenue in fiscal 2026 came from outside the US. When the rules shifted on specific products, it triggered an immediate, actual financial impact. Management had to record a $4.5 billion charge for excess inventory and purchase obligations. That is a real number right from the filings. You have to understand that geopolitical regulations can turn your supply into a liability overnight. Look at this flow. It starts at the top with government controls. Those trigger specific technical thresholds like bandwidth. That instantly restricts market access, drops demand, and boom, you hit the actual realized risk of a massive multi-billion-dollar inventory charge. Moving on to the second major risk, the supply chain. Here is the deal. They run a fabless manufacturing model. They design it, but third parties build it. Why does this matter? Because the manufacturing lead times can stretch beyond 12 months. You have to predict exactly what the market wants a year in advance. If you guess wrong, you face severe mismatches. Overestimate, and you are sitting on excess inventory. Underestimate, and you miss the market entirely. To manage this, they are putting capital on the line with prepaid capacity agreements. Furthermore, this entire operation is heavily concentrated in the Asia-Pacific region. Any regional disruption sends ripples straight through to the bottom line. It is a delicate balancing act of lead times and global logistics. Watch this sequence. Forecasting places prepaid orders with suppliers using over a 12-month lead time. If the market demand at delivery does not match the forecast, you either get hit with excess inventory write-downs or you face crippling shortages. Finally, let us break down the third critical risk. It is all about product transitions. The company is operating on an aggressive one-year architecture cadence. We are talking moving from Hopper to Blackwell to Rubin in rapid succession. Why? Because the demands of agentic AI require it. But here is the critical vulnerability. Moving this fast introduces massive execution risk. You are shipping new and prior architectures simultaneously. This complexity can lead to unanticipated quality issues, delays, or low-yielding materials affecting gross margins. They already noted inventory provisions for low-yielding material in recent quarters. On top of that, you have to watch the ecosystem. If open-source foundation models start gaining traction on competitor hardware platforms, it could erode their developer base. Execution must be flawless when you are moving at this velocity. This chart lays it all out. You see the first lifecycle overlapping with the second architecture ramp, and then the third coming right behind it. The critical zones highlight exactly where the quality, yield, and ecosystem risks peak due to this overlapping complexity. Welcome back to the training room. Today, we are breaking down the critical intersection of environmental, social, and governance commitments and the heavy-hitting legal hurdles facing tech infrastructure. Let's dig in and unpack what this means for the balance sheet. Listen up. We are looking at the foundation of corporate resilience today. You hear ESG, and you might think it is just a buzzword, but it is a massive operational pivot. The company is driving toward 100% renewable electricity for its facilities. That is huge. But here is the kicker. They also have to herd their suppliers to cover 67% of Scope 3 emissions by 2026. Why do we care? Because if they miss these targets, the market notices, stakeholders push back, and you risk severe reputational damage. Add to that the heavy regulatory scrutiny from global watchdogs, like the EU AI Act, dictating how AI models are trained and deployed. It is a complex web of compliance that requires constant vigilance and significant capital. Starting from the top with corporate operations, we branch out into the two main pillars, environmental targets like renewable energy and supplier engagement, alongside the heavy regulatory compliance required by global frameworks. Now let's look at the litigation docket, because this is where the rubber meets the road. We have a major securities class action tied to channel inventory and cryptocurrency mining demand from back in 2017 and 2018. The Supreme Court dismissed the writ of certiorari, sending this right back to the district court. This is a lingering cloud, and it does not stop there. Multiple derivative lawsuits are sitting in the wings, paused until the main event resolves. Furthermore, global regulators from France to South Korea are demanding data on GPU sales and supply allocation. These probes require massive resources. We're talking about serious time and capital spent just managing these regulatory requests. You have to monitor these dockets closely to understand the operational drag. This diagram maps the current legal hurdles. The central node splits into the primary securities class action, the paused derivative lawsuits, and the expansive global antitrust inquiries, pulling resources from across the globe. Here is the bottom line, the true test of the balance sheet. Are these lawsuits draining cash today? The filings clearly state there are no accrued contingent liabilities for these matters yet. They do not view the litigation losses as probable or estimable right now. But do not take your eyes off the regulatory friction. In September 2025, Chinese antitrust regulators flagged issues with the Mellanox acquisition compliance. And look at the direct financial hits from shifting regulations, a massive $4.5 billion charge in the first quarter of fiscal 2026 simply because changing export rules decimated demand for the H20 product, leaving excess inventory. So, while the courtroom battles have not triggered massive payouts yet, the regulatory hurdles are absolutely creating immediate financial impacts. Keep your focus on these operational risks. Our final chart breaks down the financial impact. On the left, pending lawsuits show no immediate liability. On the right, regulatory friction highlights the real, tangible financial hits like the $4.5 billion inventory charge. Welcome to our financial masterclass. Today, we are dissecting the income statement to understand the mechanics of corporate profitability and operational efficiency. Let us begin. Let us dive right into the income statement, starting at the very top, revenue. This is the total value of products and services sold by a business, serving as the absolute foundation of our financial analysis. We always ask a primary question, is the market demanding what the company supplies? For our case study today, we analyzed the fiscal 2026 data. The company reported a total revenue of $215.9 billion. That represents a 65% increase from the $130.5 billion generated in fiscal 2025. How did they achieve this scale? By dominating a specific sector. The data center market alone brought in $193.7 billion. When we analyze revenue, we are not just looking at the final aggregated number, we are analyzing the trajectory and the underlying segmental drivers. This 65% growth tells us that the core business engine is experiencing robust, sustained demand. This flowchart breaks down the top line. You can clearly see how the total revenue of $215.9 billion cascades into its primary segments, with compute and networking doing the heavy lifting, further split into specific compute and networking product lines. Moving down the income statement, we hit a critical efficiency metric, gross margin. This represents the percentage of revenue left over after subtracting the direct costs of producing the goods, known as the cost of revenue. Why does this matter so much to analysts? Because a strong gross margin means the company retains more capital from each dollar of sales to fund its broader operations. In fiscal 2026, the reported gross margin was 71.1%. Now, notice the trend. This is actually a decrease from the 75% margin achieved in fiscal 2025. Does this mean the core manufacturing efficiency is permanently impaired? Not necessarily. We must dig deeper into the footnotes. The data reveals this decrease was heavily impacted by a specific $4.5 billion charge associated with excess inventory and purchase obligations, alongside a strategic transition to new, full-scale data center solutions. You must understand the how behind a margin shift to accurately assess long-term operational health. Here we visualize the margin calculation. Starting with total revenue, we subtract the $62.5 billion in direct costs to find our gross profit. The resulting 71.1% margin points directly to the underlying $4.5 billion inventory charge that compressed the ratio. Finally, we reach the bottom line, net income. This is what remains after we subtract operating expenses, taxes, and other indirect costs from our gross profit. The primary analytical goal here is to identify trends in operating leverage. If a company's expenses are outpacing its revenue growth, it is losing efficiency and bleeding cash. But let us examine the data in our case study. In fiscal 2026, total operating expenses were $23.1 billion. That is a 41% increase from the previous year, driven heavily by necessary investments in research and development for new architectures. However, recall our top-line growth metric, revenue grew by 65%. Because revenue expanded significantly faster than the operating expenses, the company demonstrated exceptional operating leverage. This structural efficiency cascaded straight down the income statement, resulting in a net income of $120.1 billion. This proves that management's investments in R&D are yielding highly profitable returns without unnecessarily bloating the corporate structure. This final chart shows the path to the bottom line. We take our gross profit, subtract the $23.1 billion in operating expenses, account for taxes and interest, and arrive at the net income of $120.1 billion, illustrating massive operating leverage. Welcome. Today we are diving deep into the balance sheet. We are going to analyze cash, evaluate debt, and calculate the current ratio to determine if a company has the margin of safety required to power through a recession. Let us get started. Listen up, because this is where the rubber meets the road. You want to know if a company can survive a macro storm. You do not look at the income statement. You look straight at the balance sheet. The balance sheet is the ultimate lie detector. It tells you exactly what they own and exactly what they owe. We are talking about the margin of safety. It is the financial armor. Why does it matter? Because when a recession hits, credit markets freeze. If you need cash and you do not have it, you are done. But if you have the cash, you do not just survive, you play offense. How do we evaluate this? We look at the dry powder. We pull up NVIDIA's January 2026 data. They are sitting on a massive stockpile, $62.5 billion in cash, cash equivalents, and marketable securities. That is pure, unadulterated financial armor. We are going to break down exactly how this cash stacks up against what they owe, and why this specific metric is the ultimate sleep-at-night factor for evaluating corporate resilience. Stay with me, because the numbers we are about to unpack are foundational. Look at this flow. The balance sheet splits into assets and liabilities. On the asset side, you have that $62.5 billion fortress of liquidity. That flows directly into our margin of safety, counterbalancing the debt obligations. It is a visual representation of financial defense. Now we get into the heavy lifting, cash versus debt. You cannot just look at cash in a vacuum. You have to measure it against the obligations. This is how we calculate the real dry powder. Why? Because debt is a strict master. In a recession, revenues might drop, but your interest payments do not care. They are due no matter what. So how do we run the analysis? We take the total highly liquid assets, and we stack them up against the debt schedule. Let us look at the hard data for NVIDIA as of January 2026. On the liability side, they have short-term debt of $999 million. Long-term debt sits at $7.46 billion. Add that up, and you have roughly $8.4 billion in total debt. Now, match that against their $62.5 billion in liquid cash and marketable securities. The cash completely dwarfs the debt. They could pay off every single penny of their debt tomorrow and still have over $54 billion left over to fund operations or weather a severe economic freeze. That is the literal definition of dry powder. It is analytical proof of a fortress balance sheet. This chart tells the whole story in one glance. The small slice is the total debt at $8.4 billion. The massive remaining slice is the excess cash. It shows absolute dominance of liquidity over leverage. Let us bring it all home with the ultimate survival metric, the current ratio. If you want to know if a company will survive the next 12 months in a brutal recession, this is the calculation you must run. What is it? It is current assets divided by current liabilities. Current assets are what you can convert to cash within a year. Current liabilities are the bills coming due within that same year. Why is this critical? Because if this ratio drops below 1, the company is technically insolvent in the short term. They have to scramble for funding. How do we calculate it for NVIDIA? We go to the January 2026 balance sheet. Total current assets, $125.6 billion. Total current liabilities, $32.1 billion. You divide the assets by the liabilities, and you get a current ratio of roughly 3.9. 3.9. That means for every single dollar of bills coming due this year, they have nearly $4 in liquid and short-term assets sitting right there waiting to pay it. It is an astronomical level of coverage. They have the dry powder. They have the margin of safety. The math proves the resilience. Here is the exact math mapped out. We take the $125.6 billion in current assets at the top, divided by the $32.1 billion in current liabilities, dropping down to a current ratio of 3.9. Pure, undeniable short-term safety. Welcome to the tape. Today we are tearing apart the financials to find the actual cash. Let us get started. Listen to me. You cannot just look at the bottom line of the income statement and call it a day. Net income is an accounting metric. It is governed by complex rules. It tells you what you earned on paper, but it does not always tell you what actually hit the bank account. You must look at the operating cash flow. This is the lifeblood of the business. In fiscal year 2026, the net income was reported at a staggering $120,067 million. But if you look at the cash actually provided by operating activities, it was $102,718 million. That is a difference of over $17 billion. Where did it go? You have to ask yourself, is the profit real, or is the cash trapped somewhere else? We are going to find out. You must compare these two numbers every single time you analyze a business. This is how you spot the difference between paper profits and cold, hard cash. Start on the left. The income statement feeds into the gap with $120,067 million. Below it, the cash flow statement shows $102,718 million. Both point directly into the center node, representing the discrepancy. This leads us to the ultimate question: where is the cash? Now we roll up our sleeves and dig into the reconciliation. How do we get from $120,067 million in profit down to $102,718 million in cash? You have to look at the working capital. When a business is growing at a breakneck pace, it consumes cash to fund that growth. You sell products, but the clients have not paid the invoice yet. That becomes accounts receivable. In fiscal 2026, the accounts receivable balance consumed $15,399 million of cash. You also have to build products before you sell them. That is inventory. The inventory build consumed another $11,324 million. This is not an accounting trick. This is the cost of massive operational scaling. The profit is absolutely real, but the cash is temporarily parked on the balance sheet in the form of unpaid bills and unsold chips. You must monitor these operating assets. If inventory rises too fast without demand, it is a red flag. Here, it is driven by intense operational deployment. Look at the flow from top to bottom. We start with net income at the top. We add back non-cash items like stock-based compensation. Then we subtract the heavy hitters, accounts receivable and inventories, which drain cash. Follow the arrows down, and they all reconcile perfectly into the operating cash flow at the base. Here is the bottom line. The ultimate truth teller. Free cash flow. Operating cash flow is great, but a company must feed the beast. It must build data centers, buy equipment, and invest in physical infrastructure. Those are capital expenditures, and they drain your cash. To find the true cash generated that can be returned to shareholders, you take the operating cash flow of $102,718 million and subtract the purchases of property and equipment, which were $6,042 million, plus $101 million in principal payments. What are you left with? A staggering $96,575 million in free cash flow for fiscal 2026. This is the money that funds the $40,086 million in share repurchases and $974 million in dividends. Paper profits can be subject to estimates, but free cash flow does not lie. It is the ultimate metric of financial health and operational supremacy. Analyze the free cash flow, and you understand the true power of the enterprise. The diagram begins with operating cash flow on the left. The arrows flow through the deduction of capital expenditures and principal payments to arrive at the central node, free cash flow. From there, the flow expands outward to show exactly how that true cash is deployed into shareholder returns like repurchases and dividends. Listen up, people. Welcome to the session. We are rolling up our sleeves and diving straight into the belly of the beast. Item 7, management's discussion and analysis. Let's get to work. Are you paying attention? Because this is where the real homework begins. You cannot just look at the top-line gap numbers and think you know the business. You have to read Item 7. The MD&A is where management tells you exactly what is driving the machine. We are talking about the why behind the numbers. For example, when you see a massive $215.9 billion in fiscal 2026 revenue, the MD&A tells you exactly how the shift to accelerated computing and AI infrastructure made that happen. But listen to me closely, you must verify the narrative by digging into the reconciliation tables. That is how we separate the noise from the fundamental operational reality. Look at this flow right here. We start with the raw GAAP financials. Then we run it through the MD&A filter in Item 7. That isolates the true performance drivers, leading us directly to the core operational results, like that massive revenue figure. Step by step, logic and data. Let's break this down because this is where people get it wrong. Non-GAAP adjustments. Management wants to show you their core performance, so they strip out certain costs. The biggest offender, stock-based compensation. They tell you it is a non-cash charge. But let me tell you, it is a very real expense. When we look at the fiscal 2026 tape, we see GAAP operating expenses of $23.07 billion. But the non-GAAP number, just $16.69 billion. That is a gigantic gap. Over $6.12 billion of that is stock-based compensation. You have to do the math. If you add that back, you realize that paying for world-class talent is a fundamental cost of doing business. You cannot just ignore it to inflate profitability. Watch the breakdown on the screen. We take the $23.07 billion GAAP OPEX, we carve out the exclusions, and boom, there is the $6.12 billion in stock-based compensation staring right at us. That bridges us straight to the $16.69 billion non-GAAP figure. The math does not lie. Here is the absolute bottom line, folks. If you are reading the MD&A correctly, you are looking for policy shifts. Companies evolve, and their reporting evolves with them. When you read the forward-looking outlook for Q1 of fiscal 2027, there is a massive revelation. Management is changing the rules of the game. They announced they will begin including stock-based compensation right inside their non-GAAP financial measures. Why? Because it is a foundational component of their compensation program. They are projecting Q1 non-GAAP operating expenses of $7.5 billion, explicitly including $1.9 billion in SBC. This is why you read the fine print. They're acknowledging that this is a permanent, structural cost of the business. Be analytical, stay sharp, and always read Item 7. Trace the timeline with me. We move from the historical policy of excluding SBC right into the Q1 2027 policy shift. The methodology completely flips. SBC is now included, driving the Q1 outlook to $7.5 billion in non-GAAP OPEX, carrying $1.9 billion of that SBC weight. A masterclass in corporate reporting evolution. Welcome to our session on investor value and shareholder yield. We are diving into how companies return capital to their owners, specifically focusing on dividends and share repurchases. Let us get started. Listen up, because this is where the rubber meets the road for investors. When we talk about shareholder yield, we are looking directly at how a business rewards the people who own it. It is not just about revenue growth, it is about what management does with the cash generated. The basics are simple. A company either hands cash directly to shareholders as dividends, or it goes into the open market and buys back its own stock. Why does this matter? Because a disciplined capital return program prevents cash hoarding and creates undeniable shareholder value. When a company buys back shares, it reduces the overall share count. That means every remaining share represents a slightly larger piece of the company's earnings. To track this accurately, we look straight at the financing activities section of the cash flow statement. This tells us precisely if a company is serious about returning value to you, the investor. Look at this flow. Operating cash moves to free cash flow, which feeds directly into our financing activities. From there, it splits into two distinct paths, dividends and share repurchases. Both paths converge to create the total shareholder yield. Now, let us examine the hard data on the company's dividend program. Dividends are the direct cash payments deposited right into shareholder accounts. For a growth-focused technology company, you might expect dividends to be an afterthought, but we need to look at the trend to understand the financial discipline. Why does this trend matter? It shows us management's commitment to returning a steady baseline of cash while keeping enough powder dry for massive infrastructure investments. How is it scaling? We see a clear, systematic escalation. In fiscal year 2024, the company paid out $395 million in dividends. By fiscal 2025, that figure more than doubled to $834 million. And looking at the latest data for fiscal 2026, it climbed again to $974 million. This is a deliberate, analytical progression. It proves the company is generating sufficient cash not just to operate, but to sustainably increase its direct cash returns to owners year over year. Here is the visual proof. The chart maps out the fiscal years 2024 through 2026. Watch the bars step up from $395 million to $834 million, and finally hitting $974 million. It is a clear, unbroken upward trajectory in dividend distributions. Dividends are great, but share repurchases are the main event here. This is where the sheer scale of the capital return program becomes highly apparent. What are we looking at? The company buying its own stock on the open market. The basic function here is twofold, offsetting the dilution from employee stock issuance and deploying massive cash reserves efficiently. In fiscal 2024, they repurchased $9.7 billion in stock. In fiscal 2025, they accelerated that to $34.0 billion. And for fiscal 2026, a staggering $40.4 billion was deployed to buy back 282 million shares. Are they buying at reasonable prices? If we drill down into the first quarter of fiscal 2026, we see execution at average prices ranging from $106.27 to $128.65 per share. Furthermore, the board authorized an additional $60 billion for repurchases in August 2025, leaving $58.5 billion in capacity at the end of fiscal 2026. This demonstrates profound financial strength and a highly aggressive approach to shareholder yield. This chart puts the buyback volume into perspective. We see the dramatic leap from $9.7 billion in fiscal 2024, surging to $34 billion in 2025, and capping out at $40.4 billion in fiscal 2026. This is the true driver of their shareholder yield. Welcome to the tape. Today, we are following the money. We are looking at exactly what the insiders and the massive institutions are doing with their shares. Let us get started. Listen up, because analyzing insider selling requires context. Everyone panics when they see a CEO selling stock, but you have to look at the math. What are the basics? Executives use pre-planned 10b5-1 trading programs to sell shares systematically. Why do we track this? Because we need to separate routine liquidity events from a lack of conviction. How do we do that? By looking at the denominator. Our deep dive into the proxy data shows CEO Huang beneficially owns over 922.9 million shares, representing a 3.77% stake in the company. He adopted a trading plan in March 2025 to sell 6 million shares by the end of the year. Let us do the math. 6 million shares is less than 1% of his total holdings. CFO Kress holds over 4.8 million shares and plans to sell 500,000. They are maintaining massive, concentrated exposure to the company's future. You cannot look at a headline sale without looking at the retained ownership. Look at this pie chart. The tiny slice is the 6 million shares scheduled for sale under the 10b5-1 plan. The massive remaining area represents the nearly 917 million shares the CEO retains. This visual proves the massive exposure remains intact. We just saw the sales, but now we must understand the guardrails. What is the corporate governance framework holding this together? It is the insider trading policy. The basics are simple. Executives cannot just trade whenever they want. Section 16 officers require pre-clearance from legal. Why is this critical? Because it forces strict compliance and aligns executive behavior with long-term stockholder value. How do they enforce this? Through ironclad ownership guidelines. Let us deep dive into the proxy statement restrictions. The company outright bans insiders from hedging, shorting, buying on margin, or pledging their stock as collateral for loans. There is no insulating themselves from downside risk. If the stock drops, they feel the pain. Furthermore, the CEO is required to hold shares valued at 10 times his base salary. Other named executive officers must hold 3 times their salary. This structure guarantees that management has serious skin in the game at all times. This flowchart breaks down the insider trading policy. It splits into 2 main pillars: mandatory ownership and strict prohibitions. Notice how the CEO must hold 10 times his salary, while all executives are strictly barred from hedging, shorting, or pledging their shares. The guardrails are exceptionally tight. Finally, we shift our focus from the insiders to the giants, the institutional whales. What are we looking at? The ownership stakes of the largest asset managers in the world. The basics involve tracking SEC Schedule 13G filings, which mandate disclosure when a fund acquires massive stakes. Why does this matter to us? Because when you have a massive market capitalization, you need structural support. Retail investors trade, but institutions anchor the equity. How do we measure this? We extract the exact share counts from the proxy data. Let us take a deep dive into the 2 biggest players. Vanguard beneficially owns over 2.04 billion shares. That is 8.36% of the entire company. BlackRock follows right behind, holding over 1.8 billion shares, representing a 7.38% stake. When 2 asset management titans hold a combined 15% of the outstanding float, that signals profound institutional conviction. You must track if these whales are increasing or decreasing their stakes, because they form the bedrock of the stock's stability. This pie chart illustrates the sheer gravity of institutional ownership. You can clearly see Vanguard taking up 8.36% and BlackRock holding 7.38%. Together, these 2 whales account for a massive, foundational block of the total outstanding shares. Listen up, analysts. Today we are looking at the ultimate scorecard, valuation. We are breaking down the fundamentals, analyzing the bull and bear cases, and delivering the final verdict based strictly on the filings. Let us get started. Listen to me, because this is where the rubber meets the road. Everyone wants to talk about PE, PG, and PES ratios. But you cannot calculate a valid valuation multiple without the raw, fundamental truth. What is the truth? The 10K gives us the exact denominators. We are looking at fiscal 2026 revenue of $215.9 billion and GAAP diluted earnings per share of $4.90. That EPS is up from $2.94 the year prior. Now, the filings do not give you the daily stock price, so they do not print the PE ratio for you. But as an analyst, you take that $4.90 EPS and you map it against historical averages. Is the market paying a premium today compared to 2 years ago? You have to ask why. It is because the market is forward-looking. The PEG ratio, which factors in growth, requires you to look at that massive jump from $2.94 to $4.90 and project the next cycle. You must anchor your valuation models in these audited numbers, separating the market sentiment from the actual earnings power generated by the operations. Look at this structure. You have the market capitalization at the top, colliding with the hard fundamentals from the 10K, the $215.9 billion in revenue, and the $4.90 in EPS. These feed directly into your P, PS, and PEG ratios. This is the mechanical engine of valuation. Now, let us examine the bull case. Why would the market assign a premium multiple to this operation? Because the bulls see a fundamental, structural shift in the global economy. They are not looking at a chip company. They are looking at the foundational infrastructure for artificial intelligence. The numbers back up the narrative. Compute and networking revenue hit $193.4 billion in fiscal 2026. That is a 67% increase year over year. The bulls argue that the traditional PE ratio looks expensive only if you underestimate the growth curve. With a 1-year product cadence moving from Hopper to Blackwell to Rubin, the technological moat is widening. And here is the kicker for the bulls. Management repurchased $40.3 billion of stock in fiscal 2026. When a company buys back that much equity while aggressively investing in R&D, it signals immense internal confidence. The bull case relies on these data center ecosystems becoming the indispensable factories of the new industrial revolution. Here is the bull case blueprint. It rests on three pillars: massive revenue growth hitting $193.4 billion in compute, an aggressive one-year product cadence, and massive capital returns with $40.3 billion in repurchases. These three nodes justify the bullish valuation framework. You cannot be a true professional without facing the bear case. The bears look at the exact same numbers and see severe vulnerability. What happens if the geopolitical landscape fractures? We do not have to guess. In the first quarter of fiscal 2026, the company took a $4.5 billion charge for excess inventory due to shifting U.S. government export controls. The bears point to this and the looming AI diffusion regulations, arguing that access to global markets is fragile. Add in a supply chain highly concentrated in the Asia-Pacific region, and the bears warn that any disruption will compress those premium valuation multiples overnight. So, what is the verdict? The operation is generating massive fundamentals, with $130.3 billion in operating income, but it is navigating a minefield of regulatory and execution risks. You must weigh the structural AI shift against the geopolitical reality. Finally, hear me loud and clear, this is a strictly factual analysis of the 10K filings. This is not investment advice. This is not a buy or sell recommendation. Do your own homework. Class dismissed. This diagram is the ultimate balancing act. On the left, the verdict weighs the bullish fundamentals like $130.3 billion in operating income. On the right, it weighs the bearish risks, USG export controls, the massive $4.5 billion inventory charge, and supply chain concentration. You have to weigh both sides carefully.